Welcome to Petros Family Wealth. Today we're going to talk about how you can potentially amplify your Roth conversion strategy utilizing structured products. Let's go ahead and dive in. Today we're going to talk about how we can potentially utilize one of the bigger risks associated with structured products to our advantage when incorporating a Roth conversion strategy. Now, before you watch the whole video, I just want to make sure that you have seen some of our other videos about Roth conversions in general, and then also have seen a number of our videos around structured products, all the pros and cons associated with them. This video is primarily going to be utilized for folks that are incorporating or will incorporate Roth conversions, and then two, are incorporating or will incorporate structured products in their portfolio. As we go through some of these hypotheticals and examples, I just want to reiterate, this is not a recommendation for you or your family or a past recommendation for other clients. This is purely meant to be educational, to educate you, and help you become a better investor for you and your family. Just to recap two things. One is a Roth conversion is a strategy where we're taking traditional IRA assets or pre-tax assets and converting them to a Roth IRA. That movement is a taxable event, and what our hope is that growth in the Roth, which will be tax-free, is going to be more beneficial for a client's financial plan than the initial pain of paying those taxes up front. So generally, you try to utilize these in low income tax years or during certain sweet spots in retirement. And as far as the structured products recap, one of the biggest risks associated with structured products is what's called statement risk, meaning that if we invest $1,000 into an investment, and let's say the underlying investments are growing over time, the market value, or what you see on your statement, doesn't fully reflect the value of what's happening underneath the hood. And so we can use that to our advantage, having a potential discounted market value to our intrinsic value to hopefully amplify our Roth conversion strategy. So let's go ahead and take a look and see how that might play out. So what we have here is a income or yield note, and this one in particular is an example or hypothetical where there's a 25% barrier protection and is generating about a 10.25% yield, so long as the underlying investments don't go down more than 25% from the initial purchase. And this one is a 4-year deal, so I'm showing the whole potential life of this structured product. And just quickly recap, if all the underlying investments are positive on one of these snapshots, well, the client will get their principal back early and that last coupon. If markets continue to struggle, and at the end of the term, the worst performer of those underlying indices is down, but not down more than 25%. Client would again get all the principal back. And then that barrier protection, if the market's down more than that 25%, well, their principal is down 1 for 1 beyond that 25%, meaning negative 30% would equal a negative 30% principal return. Let's say, for example, a client is looking to incorporate a Roth conversion, and we try to identify an asset that we might feel has a higher probability of success as far as after that conversion, providing that tax-free gain. And I'm just going to point out as an example of right here on the snapshot, the underlying investments might be down about 17%, so about 82 and change percent from the initial purchase. But the market value is about 87%. So I'm just going to round it up to, let's say, a 90% market value. And if the client would convert at that time, their potential returns are, one, the 10% coupon based off the $1,000 par that they put in. And so they're getting, as far as the growth or the income, that's inside the Roth, they're going to get that 10% based off $1,000, not off of the $900 that they converted. Plus, they can have that potential growth if this were to mature and receive the principal back, plus that additional 10% in the growth of the principal as well. You can utilize that disparity between the market value of 90% conversion, 90 cents on the dollar, versus the intrinsic value of the 100 cents on the dollar if this were to get called early or were to mature in a couple of years and receive the principal back. So there's two ways to take a look at if we're going to take advantage of this discounted market value. One is if, let's say for example, you have a $10,000 Roth conversion budget. You can convert $10,000 of your initial investment, but you're actually only converting $9,000 of market value. So you're paying taxes on 90 cents of the dollar that's your initial investment, and just paying less in taxes and still targeting that $10,000 of initial Roth conversion that you identified. Or you can convert maybe $11,000 or $12,000 of your initial investment, but only pay taxes on that $10,000 because of that nice discount there. This is one way to hopefully increase the probabilities of that initial success off the Roth conversion, while incorporating some of the potential downsides or using this as a silver lining in your Roth conversion strategy. So that one's a little bit more technical. Hope you enjoyed that. Hopefully that was helpful and educational. If you did find it educational and helpful, please go ahead and like, subscribe, and hit that notification button. Thank you so much.